Folks, in this video, we're going to be talking about the coming inflationary pressure and how it will cause upside potential for two utility stocks. Let's get into it right now. Now, investors typically buy utility stocks primarily to earn an attractive dividend yield. I mean, these are not stocks this is no Amazon or Apple here. And while inflationary pressure can be hard on value of a stock, as we all know, because the worst thing for those high flyers is higher rates. One sector that usually rises when inflation is moderate is utilities, which also tends to be a defensive stock when the overall market is looking overbought. And right now, folks, the market is overbought. When the broad market stocks drop, investors, they seek safety in fixed income bonds or alternatively in high-yielding utility stocks. With the stock market becoming increasingly, and I mean increasingly vulnerable, and with the Fed potentially shortening their timeline on the bond buying program, as Powell have said, it may be a good idea to start looking at utility sector, especially in light of the fact that the sector is sitting near the highest level we've seen in a long, long time. I mean, this is the highest level we've seen since the initial COVID meltdown in February 2020. And notice it's hitting this level third time right now. Now, if you look at the XLU ETF, which is what we're looking at right now, you'll notice that it tested these levels back in November of 2020, again in April of 2021, and again just recently on August 6th, just a few days ago. Now, there's a good chance that the sector is going to break out higher, especially if we see an expansion in economy and increased inflationary pressure, which is the most likely scenario on the horizon. Now, if we do go the other way and we head back into the lockdown, which is not likely, but again, I have to look at all scenarios, we would see speculative stocks sell off much faster than yield-rich defensive utilities. So it's a good offensive play and a good defensive play in my personal opinion. So I want to take a look at two stocks, which I'm really liking right now. They're defensive, but I also think they're going to give us a little upside. Now, this one here looks like it ran up a little too much. It's going to pull back. But remember, these are all stocks that I'm looking over the next quarter. So first stock is Chesapeake Utilities. It's a utility company, engages in natural gas distribution, transmission, propane distribution, and marketing. We can't forget the marketing part. Now, Chesapeake's three natural gas distribution divisions, they serve residential, commercial, and industrial customers in southern Delaware, Maryland, and Florida. I mean, how did Florida get into the mix? Hard to figure out, but they got a pretty good handle on the East Coast. 1 year return, almost 50%. Earnings per share growth versus previous year, almost 22% growth. Here's the part that I like the most. Dividend payout ratio, 39.82%. That's pretty good. Earnings have been better than expected the past 4 quarters, and I have a price target of $142 per share over the next quarter, especially if things begin getting bumpy in the overall market. And I'm telling you, based on the fragmentation and the divergence, don't get me started because there's probably 30 videos that I've done on all of that. I do think the stock itself is going to back down, maybe go to the 123 level. So you may want to wait for a pullback. But overall, this is a good stock. It's a defensive stock, and it would be a good time to add some defensiveness or defensive stocks into your portfolio because this market's not going to continue going at this rate forever. Next stock, Brookfield Infrastructure Partners. Now, the current business consists of ownership and operation of premium electricity transmission systems and timberlands in North and South America. Now, this is a good time to own lumber. And it seeks acquisition opportunities in other infrastructure sectors with similar attributes. And right now, you guys know infrastructure. The company, I mean, we're signing the bill, I think, later today from what I understand, or it's getting close to it. I mean, there's going to be trillions of dollars flowing into infrastructure. The company has strong diversification into railroad lines, properties, toll roads, ports, energy transmission lines, and other assets that it manages, which makes it a bit more unique and less risky than traditional one-trick pony utility companies. Although this company's been around the block for many, many years. 1 year return, 25%, which means it's kind of choppy, but it still has substantial upside. But remember, it's a defensive stock. Earnings per share growth versus previous quarter, 125% increase. Earnings per share growth versus previous year, 390+% increase. This company's in the right place at the right time. Earnings estimates have been better the last 4 quarters back to back, and there's currently a price target of about $70 per share. And based on the choppiness that I'm seeing, if this sucker breaks 56, there's no stopping back. So look for a target of $70, and if market volatility increases, overall market volatility, which is likely considering the sideways choppiness we've been seeing, there's a good chance we'll see more upside from this stock. These stocks tend to go up when markets soften. So utilities, and more utilities. Again, I love talking about exciting stocks more than the next guy, but this is not a time to be a hero, and this is a time to be defensive. Now, I've got something really important, something timely, something you need to pay attention to. From 1993 all the way to 2021, that's 28 years? Traders would have lost 10% of their cash buying and holding S&P stocks during the day. Yes, you would have lost 10% of your money. Yet, if you bought at the close and sold again right at the open, you could have made 812% return. Where did all the gains come from? Come on, you figured it out by now. Overnight moves. All those overnight moves that happen when America is sleeping in China and Asia and Europe, markets open higher or lower, that's where the money is. And one former $700 million hedge fund trader, he just revealed how he's exploiting these overnight moves on a handful of stocks every single day. You don't want to miss out on this. Click the link below to see the stock that he's trading next. Follow that link. Don't miss out. Check this out. Learn how instead of losing 10%, you could have potentially made 812% with no micromanagement, no day trading, and no monkey business. Man, I hate monkey business. Well, just depends what kind of business it is. Follow the link below and see which stock he's looking at next. And folks, make sure to like this video. Subscribe to this channel. Where else are you going to get info like this on utility stocks? For crying out loud. Stay ahead of the market by being the first to be notified when I post my next video. And I'll see you guys soon. Bye.